Let me ask you something that most people heading into retirement never think about until it's too late. What if the single biggest financial mistake you make in retirement has nothing to do with your investments, your Social Security timing, or even your withdrawal strategy? What if it's something your employer has been quietly doing for you for the last 30 years, and the moment you retire, it just stops? No warning, no replacement, no transition plan, just gone, and the IRS sends you the bill. That's exactly what happens to millions of Americans every single year. And today, on Retire Guide, we're going to walk through the 5 critical tax protections your employer runs on your behalf. Right now, protections most people don't even know exist, and what you must do before your final paycheck to make sure you're not blindsided in your very first year of retirement. This is one of those videos you're going to want to watch all the way through, because each of these 5 things builds on the last, and the final one is the one that catches people completely off guard. So stay with me. And if you're new here and you're within 10 years of retirement, or you've got a parent or spouse who has hit that subscribe button right now, we put out content every week specifically designed to protect your retirement income from the mistakes most people make simply because nobody told them. Welcome to Retire Guide. Now, to understand why this matters so much, you have to think about what's actually happening behind the scenes at your workplace right now. Your employer is essentially running an automated tax management system on your behalf. Every single payday, they're calculating withholding, submitting payments to the IRS, sheltering portions of your income before taxes ever touch it, and in many cases, literally adding free money to your retirement accounts. The system has been running quietly in the background for your entire career. It requires nothing from you. It protects you automatically, and it is extraordinarily valuable. The combined annual value of everything we're about to cover when you add it all up easily exceeds $11,000 per year for the typical pre-retiree. And if you lose those protections and don't replace them with a proper plan, that $11,000 compounding loss over a 25-year retirement doesn't just sting. It runs well into 6 figures of unnecessary tax erosion on your retirement savings. So let's get into it. The first protection, and the one that creates the most immediate pain, is automatic tax withholding. Right now, every time you get a paycheck, your employer sends a portion of it directly to the IRS on your behalf. You never see it. You never have to think about it. It just happens. When you retire and start drawing income from your IRA, your 401k, or your Social Security benefits, that automatic system disappears completely. Here's what most people don't realize. Social Security defaults to 0 withholding. That means if you don't specifically request that taxes be taken out, the IRS receives nothing from your Social Security payments all year and then hits you with a lump sum bill at tax time. For most retirees, up to 85% of Social Security benefits are taxable, depending on your combined income. So this isn't small money we're talking about. IRA custodians do withhold taxes, but they typically default to just 10%. And if your actual marginal rate is 22% or higher, which it often is for retirees with multiple income sources, you're still coming up short every single month without knowing it. The IRS has a rule called the underpayment penalty, and it kicks in when you haven't paid at least 90% of your current year tax bill, or 100% of what you owed the prior year, 110% if your income exceeds $150,000. This is how people end up with surprise penalties in their very first year of retirement, not because they did anything wrong, simply because the automatic system they relied on for decades quietly vanished. The solution is to set up quarterly estimated tax payments using IRS Form 1040-ES before you retire, and to file Form W-4V directly with the Social Security Administration to request voluntary withholding, typically at 7%, 10%, 12%, or 22%, depending on your situation. Get this done before your last paycheck, not after. Because once you retire and that first quarter passes with 0 payments, you're already behind. The second protection is what's called the 401k contribution shelter. For 2025, workers can contribute up to $23,500 to a traditional 401k. And if you're 50 or older, that jumps to $31,000 with the standard catch-up contribution. But here's something that's brand new and most people don't know about yet. The Secure 2.0 Act created what's called the Super Catch-up Contribution for workers aged 60, 61, 62, and 63 specifically. Starting in 2025, if you fall in that age window, you can contribute up to $34,750 to your 401k. That's the highest pre-tax shelter available to working Americans right now. Every dollar you put into a traditional 401k reduces your taxable income dollar for dollar in that year. If you're in the 22% bracket, maxing out the standard catch-up at $31,000 saves you roughly $6,820 in federal taxes alone that year. At the super catch-up level, we're talking about sheltering up to $34,750 from taxes savings that literally cannot happen once you're retired and no longer employed. The day you leave your job, this shelter closes permanently. You cannot contribute to your former employer's 401k. You cannot recreate this level of pre-tax sheltering through any other retirement vehicle available to you in retirement. This is why your final working years, especially if you're between 60 and 63, are what financial planners often call a tax optimization sprint. You have a narrow window where the contribution limits are at their absolute highest, and every year you don't fully utilize them as a year of tax savings you can never recover. The third protection is the Health Savings Account, or HSA, and this one has a hard deadline that most people don't know about until they've already crossed it. If you have a high deductible health plan through your employer, you may be contributing to an HSA right now. For 2025, individuals can contribute up to $4,300 annually, and families can contribute up to $8,550. If you're 55 or older, you can add an extra $1,000 on top of that. HSA contributions offer what's known as triple tax advantages. Your contributions go in pre-tax, reducing your taxable income. The money grows tax-free inside the account, and you can withdraw it tax-free for qualified medical expenses. There is no other savings vehicle in the United States tax code that gives you all three of those benefits simultaneously. Not a Roth IRA, not a 529, nothing. But here's the part that catches retirees off guard every single year. The moment you enroll in Medicare, which most people do at 65, HSA contributions become illegal, not just inadvisable, illegal. You will owe income tax plus a 6% excise penalty on any HSA contribution you make after Medicare enrollment. The IRS does not give you a grace period or a warning. If you make an HSA contribution in the same year you enroll in Medicare, you will owe back taxes on it. This means your final working years before Medicare enrollment are your last legal window to build your HSA balance as high as possible. That account, once funded, never expires. The money stays invested, keeps growing tax-free, and can be used to cover Medicare premiums, copays, dental expenses, vision, long-term care insurance premiums, and hundreds of other qualified medical costs throughout your entire retirement. One strategy worth knowing: if you plan to retire at 64 and enroll in Medicare at 65, stop HSA contributions at least 6 months before you apply for Medicare, because Medicare coverage can be backdated up to 6 months. That backdating can inadvertently create a period where you were technically on Medicare but still contributing, triggering the penalty. The fourth protection is one that's almost invisible on your pay stub, but it adds up to thousands of dollars every year. When your employer offers health, dental, vision, and life insurance, and you pay your share of the premium through payroll deductions, those deductions come out of your paycheck before taxes are calculated. This is called a Section 125 cafeteria plan, or a pre-tax premium arrangement. Your employer essentially removes your insurance cost from your gross income before the IRS sees it, which means you're never taxed on that money. When you retire, every dollar you spend on health insurance premiums, whether through COBRA, the ACA Marketplace, or any other individual plan, comes out of after-tax dollars. If you're spending $700 per month on health coverage in retirement, that's $8,400 per year you're paying with money that's already been taxed. At a 22% effective rate, that's a real cost of roughly $10,169 to put $8,400 after tax in your pocket for those premiums. The pre-tax benefit your employer provided was quietly worth over $800 per year to you, and it disappears on day one of retirement. There isn't a perfect replacement for this one, but knowing about it means you can factor it into your retirement income planning accurately. Consider whether a health reimbursement arrangement might be available through a part-time consulting arrangement, and make sure your withdrawal strategy accounts for this increased effective cost of healthcare coverage. The fifth protection is the one that hurts the most emotionally, because it was free money employer matching contributions. The average employer match on 401k's contributions in the United States is between 4% and 6% of salary, with many companies matching dollar for dollar up to 3% and 50 cents on the dollar up to the next 3%. On a $90,000 salary with a typical 4% match, that's $3,600 per year going into your account at no cost to you. Fully vested over time, that's real retirement wealth that required nothing from you but continued employment. The day you retire, that stops. And while that's obvious, what people don't consider is the compounding effect of that lost contribution over what could be a 25 to 30-year retirement. $3,600 per year at a 6% average growth rate over 25 years is over $197,000. That's the opportunity cost of the employer match ending, not the account balance you walk away with, but the additional wealth that would have accumulated if you'd continued working even a few more years and capturing that match. This doesn't mean you should delay retirement just to keep getting the match, but it does mean that your final working years are an exceptionally valuable accumulation window, and walking away even 6 to 12 months earlier than necessary can have a larger long-term financial impact than most people realize. Now here's what ties all 5 of these together, and this is the insight that most retirement advice misses entirely. When you retire, the IRS does not reduce what it expects from you. Your tax obligations don't soften because your employer is no longer managing them. The only thing that changes is that the protections disappear and the responsibility shifts entirely to you. The IRS isn't unsympathetic. It just doesn't send you a letter saying, "Hey, we noticed your employer stopped withholding for you. Want to set up estimated payments?" You're expected to know, and if you don't know, the penalties are the same as if you simply chose not to pay. This is why the months leading up to your final paycheck are genuinely the most important financial planning window of your entire career. Not because you can create new opportunities, but because you can protect the ones that are about to close permanently. Max out the 401k with every contribution limit available to you, including the super catch-up if you're between 60 and 63. Load your HSA as aggressively as possible in the years before Medicare enrollment, and stop contributions at least 6 months before you apply. Get your estimated tax payment system set up before you leave work, not after. File the W-4V with Social Security so your benefits withhold at the right rate from day one, and factor the after-tax cost of health insurance into every single income projection you make for retirement, because the pre-tax premium benefit disappearing is a real and immediate cost increase. The retirees who navigate this transition smoothly aren't necessarily the ones with the most money or the best investments. They're the ones who understood what was being done for them quietly, automatically, every single payday, and who had a plan in place to replace it before it disappeared. The ones who struggle are often the ones who assumed retirement income would feel similar to employment income, only to discover in April of their first retirement year that their tax situation had fundamentally changed and nobody had warned them. You now have that warning. And the fact that you're watching this kind of content means you're already ahead of most people who will retire this year. If this video opened your eyes to something you hadn't considered before, do me a favor and drop a comment below. Tell me which of these 5 protections surprised you the most. Was it the HSA Medicare deadline? The estimated payment gap? The super catch-up contribution you didn't know existed? I read every comment on this channel, and your question might be the topic of our next video. This community is built on real questions from real people planning real retirements, and every comment helps us make better content for everyone here. And if you know someone, a coworker, a sibling, a friend, who's within 5 years of retirement and hasn't thought about any of this, share this video with them right now. One share could save them thousands of dollars in penalties and missed opportunities. That's not an exaggeration. That's just math. We'll see you in the next one. Stay sharp, stay informed, and keep building the retirement you actually deserve.